The Zacks rank, value, momentum, growth, and income all factor into Zacks rank buys.
Time to hear about a couple of more interesting growth and income stocks with the editor of our income investor service, Ryan McQueeney. So Johnson & Johnson tops your radar. They just reported earnings, right?
Yes, just this week. One of our first reporters that we hold in the income investor portfolio.
Oh.
Impressive results for Johnson & Johnson. Adjusted earnings of $2.05. That was a 2-cent beat. Revenue inched a little bit higher, about 3.6% growth year over year. That also beat expectations. And then, as is the key in this market environment, it's got to be a beat and raise quarter.
Yeah.
Raised guidance as well. Stock responded very positively. Investors liked that report. As we can see here, this is a 5-day look, and you can see the gap up after the earnings results earlier this week. And then what I love about this chart is that it doesn't stop at that gap up. It's a continued surge higher in the days after the earnings report, which I think is the type of post-earnings trend that you want to follow if you're going to be jumping on any of these, in the wake of an earnings report. Catching a great gap up right ahead of the report, always good. But that's a roll of the dice. Mm-hmm. A lot of the time it takes several days, even weeks, for that post-earnings momentum to fully play out. And so there are opportunities there. And, that's if you're trading these things. We at the Income Investor Portfolio like to buy and hold these things for a long time.
Sure.
And with that in mind, I do want to just kind of kick this out a little bit. We're looking at the 5-day chart now. Let's just kick it out a month, maybe even 3 months, so we can get a better picture. It got caught in that market-wide pullback last week, and even with that post-earnings momentum, we're barely back to where we were a month ago. So, it's an interesting kind of tale of two coins there, tale of two cities, both sides of the coin,
Yeah,
whatever
right.
phrase you want to
Whatever they call it, yeah.
Definitely.
Yeah. Did I read correctly somewhere that this company has beat every quarter for more than 5 years?
Yes, it has one of the most impressive earnings track records on the book, and that's why I'm saying you need to have a beat and raise quarter, especially when you're a company like that just it always beats by a penny or 2 pennies, whatever you want to do. It's more about revenue, some key line items, and then the raised guidance.
Then there's Community Healthcare Trust, which is a healthcare REIT, correct?
Yeah, so this is our latest addition to the Income Investor Portfolio service. I wanted to get some REIT exposure. We've talked about several REITs on this program over the last few weeks.
Yeah.
They own non-urban, local community healthcare facilities. So about 91 properties across the country right now. Mm-hmm. That interests me for several reasons. I think one of the most exciting things that I think about that in terms of buying and holding for a long time is it's kind of a recession-proof industry. That's not a concern right now because the economy is firing on all cylinders, but it seems like something an investor would be interested in holding during a down period is you're going to get the cash flow of a REIT. And, community healthcare facilities aren't going to be something that's necessarily feeling the effects of a recession like real estate, commercial or personal real estate. That might really feel the effects of a recession.
Yeah.
So it's interesting, and I think probably would generate more attention during times like that. But right now, we're talking about something with a 5.5% dividend yield. We're talking about something with a 90% occupancy rate and has over 60% of its mortgage debt fixed, which is really important right now as interest rates continue to rise, cost of borrowing continues to rise. That variable mortgage debt, the unfixed debt, that's going to get more expensive, and that's going to chew into earnings for these REITs. 60% isn't perfect. We'd love 100% of it to be fixed, but it's certainly a vast majority, and that's something we like to see for REITs in these current conditions. Now, the other key detail there is we want to see stable or increasing funds from operations. On the Zacks website, the funds from operations actually appear like our regular earnings, but we actually are looking at the FFO per share, not the earnings per share. It's kind of an interesting thing you get into in the REIT world. But as we can see in the soon-to-be reported quarter, 35.5% growth there. That's going to come out to about 17.7% in the full year, and then same rate of expansion into the next year. They've been doing a great job growing their funds from operation. That's coming on the back of strong revenue growth. Still buying properties, still expanding the business. A lot of things to like here.
All right. And you say both of these are in the income investor?
Both are in the income investor portfolio. I do not own either personally right now.
All right. Thanks for that. Interesting as always. Don't forget, if you want more interesting information that Ryan imparts, you've got his Tech Talk Tuesdays podcast on our website, Zacks.com, on the podcast page, and his Monday through Thursday live streaming video, Free Lunch, where he covers a multitude of topics. You can catch that on most major live streaming platforms when it comes to video. With Ryan, I'm Terry Ruffalo.